Your paycheck has arrived. You open your phone, glance at the balance, and the number has grown. You feel a certain sense of security. That money is there, safe, saved away. You assume that money physically exists somewhere. It doesn't. It never did. Most people have a deeply ingrained imagination of a bank. A bank is a safe. You put your money in. The bank keeps it secure for you, and you take it out when needed. The deposited money is yours, always there, safe. This imagination is wrong. In 2014, the Bank of England published a quarterly bulletin. It wasn't written by a radical economist. It wasn't an academic paper. It was an official document released by one of the oldest central banks in the world. It contained a sentence: commercial banks create money out of nothing when they extend loans, not transferring existing money, not using depositors' savings. It is created out of nothing. To understand this, you first need to know a more fundamental fact. Debt is older than money. We usually assume the order of economic evolution goes like this: first barter, then the invention of money, and only then credit and debt. This order is written into almost every economics textbook. In 2011, anthropologist David Graeber published Debt, the first 5,000 years. He spent 10 years gathering cross-disciplinary evidence from archaeology, anthropology, and history, and then reached a conclusion: that primitive barter society never existed. Archaeologists have searched the globe and cannot find a single prehistoric society where barter was the primary economic mode. Not a single one. The truly oldest economic records come from Mesopotamian clay tablets dating back to 3000 BC. What those tablets recorded was not barter. It was credit accounts. It was debt records, like how much grain you owe me, how much labor I owe you. Before money appeared, debt already existed. Debt is the mother of money. In 1694, the Bank of England was established. It was the world's first modern central bank. The way it was established helps you understand the underlying logic of all banks today. The British government desperately needed money to wage war, and the royal treasury was empty. A group of merchants proposed: we will form a bank and lend the government £1.2 million. The government will pay us interest, and at the same time grant us the right to issue banknotes. The government agreed. Where did that £1.2 million come from? That group of merchants raised funds from the public and only gathered about £720,000 in cash. For the rest, they used that £720,000 as collateral and wrote out other bills out of nothing to make up the £1.2 million. On its very first day of business, the Bank of England lent out a sum of money it did not fully possess. This is the starting point of the modern banking system. Today's banks do the exact same thing, just more systematically. When you deposit $1,000 into a bank, the bank does not lock that $1,000 in a safe. According to the fractional reserve system, the bank only needs to keep a small part of it, say 100, as a reserve, and the remaining 900 can be lent to someone else. The person who borrowed that 900 deposits the money into another bank. That bank keeps 90 and lends out 810. Cycling through like this, your initial $1,000 can turn into nearly $10,000 of currency circulating in the market through the banking system. This is how money is created. It is not dug out from mines. It is not printed from the treasury. It grows out of loan contracts one by one. So what essentially is that number in your salary account? It is a promise. The bank's promise to you. And the bank's ability to make this promise is built upon the loans it extends to others. And the value of those loans is built upon the borrower's ability to repay. Every layer is a promise stacked on top of a promise. If one day, everyone went to the bank at the same time to withdraw all their deposits, that money wouldn't be enough. It has never been enough. This is not a banking crime. This is system design. In 2008, this system temporarily lost the thing it needed most: everyone choosing to believe in it at the same time. What the result was, you know. So what does this have to do with you? You work hard every month, save money, and try to accumulate wealth. There is nothing wrong with this in itself. But if you don't understand what money is, you don't understand what you are doing. What is inflation? It is those new currencies created out of nothing by the banking system quietly lowering the purchasing power of your existing money. You saved for 10 years. The number didn't change, but what you can buy became less. Where did that missing purchasing power go? It was redistributed within the system through the process of money creation. This is not a conspiracy. This is a mechanism. You don't need to agree with it, but you need to know it, because if you don't know it, you can only operate within its rules without knowing what those rules are. Those rules, to those who understand them, are a set of readable game instructions. To those who don't understand them, it is just an invisible wind. The history of money is not a story about wealth accumulation. It is a story about trust, debt, and collective imagination. Those Mesopotamian clay tablets, those ledgers of the 1694 English merchants, that number you saw when you opened your phone this morning, are all different versions of the exact same thing. One promise stacked on top of another promise, stacked on top of more promises, propping up the world you live in. You go to work every day, trading time to watch that number grow, and then trading that number back for real life, using real time to exchange for a systemic promise, and then using that promise to trade back for real things. This system works well most of the time, but occasionally, at certain moments, someone will start to think, if everyone wants to trade it back at the same time, how much is that promise actually worth?